welcome back to the Williams Real Estate channel. Today we are discussing all things self-managed super fund. So we'll kick it off by talking about what is the self-managed super fund, how you can set up your own fund to buy property in, how I've been doing it recent years, how I've been managing my own super, and what I plan to do in 2025, what I'm doing now and for the future years ahead. Before we get into it all, this is by no means financial advice. This is my story. This is what I'm doing. Take it with a grain of salt. Go and talk to your financial planner, advisor, accountant. Do whatever you got to do. I can't give financial advice. I'm not a financial advisor, but this is my story and this is what I'm doing. And if you want help buying an investment property, I help people build long-term sustainable property portfolios by buying in your personal name, in trusts, and also in self-managed super funds. So with that said, we'll get into it. What is a self-managed super fund? So just to step back for a second, it's your super. Everyone needs to contribute to their super when they have a job. So 12% of your gross income goes into a super fund. And if you elect that to be managed by your super fund company that's managing your super for you, typically it's invested into liquid markets. So the stock markets, 70% goes typically offshore to the likes of the US. So the Dow Jones, S&P 500, it's invested in, and around 30% is invested in the Australian shares and property market. So heavily into the liquid markets if you're not managing it yourself. You can also gear your super within your fund to your age bracket. So if you're in your 20s or 30s, it'll be geared more to risk, higher return. And as you get older, if you elect your age bracket, it's geared to lesser, riskier asset classes like property and cash versus the liquid markets like stock markets. You can also elect to carve up your funds or your cash into either 100% cash or 100% Australian shares or 100% global shares. Gives you that flexibility within your fund. You can also set up a self-managed super fund where you actually can buy property within. So we'll get into that. Before we get into that of how to set it up and the steps to do so and things to know about the self-managed super fund, I'll get into why it is critical and very important now to manage your funds within your super in 2025. We are now in a similar point of the cycle of 2006 based off the 18-year land cycle. So I'm forever thankful that I came across the work from Philip J. Anderson, Fred Harrison, Akhil Patel. These guys in the industry who talk to the 18-year land cycle are complete legends of the game because it is all driven by the land market. So you will see other videos that I've done talks to this 18-year land cycle. You can look at them and dig into more detail. But for today, I came across this 18-year land cycle about post-GFC, around 2012-13. Current cycle started in 2012. So when the GFC hit, I recalled my parents complaining about losing 50% of their super fund. The cash or the funds in their super went down by 50% in the GFC. So that was the last GFC. 2008 was the last end of cycle land-driven downturn. We have since recovered out of that, as this consists of 14 years up, 14 years of expansion, and 4 years of severe downturn come into cycle. So we recovered out of the 2008 GFC. 2012 led us up to the peak in 2019 before we went through the mid-cycle slowdown, which was COVID. We are now on the way at the races, and the markets are due to top out in 2026 to 27 before we'll go through the next GFC-like event, which will be like 2008 on steroids come 2028. So during the mid-cycle slowdowns, stock markets can take a 30 to 40% correction. Just like what happened from around early 2020, topped out at 7,200 points. This is in the ASX 200 in Australia, and it troughed out around 4,500 points. So from peak to trough, lost 30-40% in the mid-cycle. Same thing happened in 2000 to 2001 too, the dot-com bust. We are now away at the races in 2025. We are now here. Equivalent point of the cycle in the prior cycle is around 2006. So mid-late 2006. So come to 2026, 27, it'll be like the peak market of 2007. October 2007 will be around October 2027. Come 2028, we're due for the next GFC-like event or the recession we had to have in the early 90s, where the stock markets will take a 40 to 50% correction. Sometimes can go even more south. So brings us back to super. If you've got your super geared into the liquid markets in the stock markets in Australia or the US, it could be exposed to that 40 to 50% correction, also known as losing a lot of money very quickly, come 2028, 9, 30, towards the end of this decade, the stock markets are due to absolutely get hammered. So, just like in 2008, that's what happened. I'm looking to avoid that, obviously, preserve the capital. And during this period now, I'm now thinking, well, where do you put your money? You can put it in cash, but inflation will typically can run higher towards this period as the central banks will drop rates low, they'll print a lot of money, that'll set off inflation. Sure, you'll get a couple of percent, 2, 3, 4% return on that cash in terms of interest on that cash, but the value of that cash will continue to lose its buying power, so it'll ultimately get eroded if you just leave it in cash. So what I'm doing is I am setting up my self-managed super fund so I can buy property within, and the property we're buying today is the same property we're buying in people's personal names or in a trust or in a super. It is the entry-level, blue-collar, working-class, high-yielding, affordable housing. Because affordable housing will become in the most strongest demand in the future years ahead. In times of crisis, the demand shifts to affordable. So what's affordable? Anything under the build cost. So if you're buying a unit, if you're buying units under 600, it's considered affordable because that's the replacement value. Houses under same price point, under 600. So we're buying individual units, villas, townhouses between 250 or 235 to 450. Houses 250 to 450. Once we're hitting about 500-600, that's duplexes, so 2 units on one site, so 300 a piece. Once we're hitting about 700-800, that's blocks of 3s, blocks of 4s, blocks of apartments. So small blocks, 700-800. Once we're hitting about $1 million, $1.5 million, blocks of 5s and 6s. And same concept goes for buying, say, a block of 10. We don't want to spend more than 3 million, so 300 a piece, because it is essentially half the replacement value with strong yields between 6 to 8%. So if you can buy stuff for half the replacement value with strong yields of 6 to 8%, that is an undervalued asset that will have future prospects of growth, even in a time of crisis. So when the market does turn, come 2027-28, the rush will go to the affordable end of the market, where people just need a roof above their head. The demand shifts to that affordable end, supply and demand. If there's more demand than supply, prices will rise. So you'll find the actual bottom end rises in a time of crisis because the demand shifts there. The government drops interest rates to near zero. They print a lot of money. That soaks into asset values. That pushes up the asset value price. The federal government will come in and come up with new home buying schemes for first home buyers. They may even go lower than 5% deposit. They might even come up with a new 2 or 3% deposit scheme or shared equity scheme to help first home buyers into the market. That all feeds into the bottom end. So the bottom end rises in a time of crisis. All the savvy investors come in and snap up all the deals. That pushes pent up demand in that affordable end. So the affordable end rises in time of crisis. Meanwhile, the top end of town is getting hammered. So commercial real estate, new and off the plan, that can all get smashed, especially if it goes vacant. Warehouses, industrial, retail space, vacant land, that all gets absolutely smashed in the time of crisis. The blue chip mansions, shiny homes, new and off the plan stuff all get hammered during the time of crisis. So like the next GFC event, which we're due, and the demand will shift to the affordable end and the affordable end will rise. So I'm now moving my money out of invested that has been fully invested in the ASX since 2021 to date. I came across this 18-year land cycle framework. Phil Anderson and the team at Property Share Market Economics, if you haven't heard of them, look them up, subscribe, get on their content because it's very valuable information. I came across them around 2015, 2016 in the first recovery of the current cycle. I then geared my super back in June, so mid 2019, before the market topped out before COVID. So I didn't know, neither did the guys at Property Share Market Economics know about the COVID recession that was around the corner in mid-late 2019, but we were due for the mid-cycle slowdown. So I shifted all my super into cash in June 19. At the time, people thought I was crazy, even my older relatives, grandparents that had been invested for many years thought I was crazy that you're putting your money into cash when there's future prospects of growth. Typically towards the tail end of a boom, everyone becomes more euphoric and bullish of the markets. That's usually the greed comes in. That's typically when it's the most dangerous time where the downside risk is higher. Sound familiar to today? So I had it in cash in mid-late 2019. So I remember gearing it into full cash around 7,000 points. Come early 2020, the market started to tank. 2020, 21, I then geared it back into the ASX, Australian share market, around 5,000 points. It troughed out around 4.5, but once it came down about 5,000 points, I started gearing it back in, and as of around 21, I was fully invested into the market. Obviously, it was the hardest time to put your money back in, most scariest time, but that's when you have to be greedy when others are fearful, and fearful when others are greedy, just like what Warren Buffett says. And maybe you may think that the world's going to come to an end and the whole world's going to melt down like what everyone was doing, going and buying toilet rolls and all that sort of shit during the time. But I was gearing all my cash back into the ASX, and the ASX typically outperforms in the second half of the cycle as the land market opens up, property construction kicks into gear, that demands on commodities such as coal and iron ore to go into manufacturing development around the world. That draws on our industries in the mining sector, so that sets off our mines. BHP, Rio Tinto, they're all booming. Also, credit becomes easier. Banking stocks typically outperform in the second half of the cycle. That's why we're seeing the likes of CBA, Westpac hitting all-time highs. That's all invested in the ASX. So the ASX outperforms in the later stages of the cycle. So I geared it 100% into Australian shares from 2021 to date. now we are again approaching a peak market. I don't want to lose 50% of the capital because I started here with about 30 or 40 grand, whacked it into the ASX. Now we're hitting over 200,000 because I've avoided the downturn, put the cash into the market during a trough, and I've ridden the growth to date, and now it's hitting 8,000, 9,000 points. So it's come up very strong. Obviously, we've been contributing to it as well. And now we're reaching a top of the market where I've now decided to set up my self-managed super fund to buy property in because I'm going to avoid this 50% correction in the times ahead. And I don't see the stock markets globally or in Australia having solid growth over the next 10 years as we're due to go through the end of cycle land-driven downturn where they'll take a good hit. Sure, you'll make the gains. If you invested for the long term, you will eventually recoup those gains, but typically it'll take you 10 years after the reckoning of the next land-driven downturn to recoup the gain come peak market. So I would rather, this is what I'm doing, is I'm gearing it into cash, let the market tank, buying up real estate during this time and riding it through that next wave. So in affordable stock is what I'm doing. So how to set it up? How to set up first of all, you'd need a good accountant. Number one, get a good accountant. If you need help, if you want help with our services, and if you sign up with us, I can send you in the directions of everyone that you need to help you set up your self-managed super fund. You need a good accountant. Not every Joe Blow are the best guys to use. You need to use top of the game type of people. Costs money to make money. You need to invest in working with very good people to get you to the ultimate level you want to achieve. So get a good accountant. First thing they'll have to do is they'll apply to the ATO to set up your super fund. That application will include setting up a corporate trustee, which is a company. The company will be the trustee of the fund, the self-managed super fund, and you can be the directors of that company, or yourself and your partner can be the directors of the company, which is then the trustee of the self-managed super fund deed. And then if you're looking to buy property, you've got two options. You can either buy it with cash, or if you're looking to gear up your cash in your super to borrow, because you can borrow within your self-managed super fund, you'll need to set up a bear trust. So then the bank can lend you a loan, which then sits underneath that. Once that's then set up, you'll transfer the funds from your current super fund into the self-managed super fund with the appropriate accounts and bank accounts. So I'm in the process now of doing this. And as the market continues to run, I'm going to trim off the investments out of the stock markets into cash to then provide deposits to then buy investment properties within. So once that's set up, then you'll go and get a pre-approval from your mortgage broker. If you need a mortgage broker, and if you're looking to work with us, I can connect you with a mortgage broker as well. So once that's all set up and you've got your pre-approval, then you're in the business of buying a property. So things to note when buying a property within your super. Things to know, number one, The minimum cash you need typically is around 200K cash. And that's essentially, I've got about 200, 250K cash personally, myself and my wife. So we're consolidating our cash, setting up one fund to buy a property. You will typically need at least 20, if not 30% deposit, depending on the deal. So if you can get a yield, you need strong rental yield as well. So strong rental yields of 6 to 8%. So the properties are self-sufficient, they're paying for themselves. So depending on the yield you can buy, will depend on how much deposit you need to put down. So, I mean, personally, we've got about 200K and I'm looking to get into 3 properties, 2 in Melbourne, 1 in Sydney. Based off the 18-year land cycle, these markets are due to outperform over the next future years in the established stock that will be rising in the time of crisis when the market does turn, and also we'll be able to spread our capital across 2 or 3 deals. Rather than using that to buy one, I can get into 2 or 3 deals easily with 200 grand cash, provided that you get the good yield, you can just use a 20% deposit. Something to also note is you can't leverage. So you can't buy a property in the super and then refinance to buy a second property, like what you can do in your personal name or in a trust. You can't leverage or refinance from use equity within one property to the next. You can't do that within a super fund. You can only use the capital you've got for individual deposits for individual property. So there's slightly more regulation on buying property within your self-managed super. The government looks to de-risk it, so you can't leverage. So for that reason, you need to break it up into smaller deposits and get strong yields, so then you can access down to a 20% deposit. So then you can buy multiple properties. So another thing, and you can't also do major renovations or development. So typically you can do minor upgrades, so paint, flooring type of thing, minor renovations, but you can't do extensive knockdown, rebuild, or major renovation, structural changes to the property, as again, the government looks to create a lower risk environment for managing super funds. So for that reason, you can buy slightly tired properties that you can add some value by paint or flooring, maybe upgrade a kitchen, but that's pretty much about it in terms of what you can do. So ideally you want to find tenant ready properties with strong yields, well under the intrinsic value, well under the replacement costs, that will have good prospects of growth in the future years ahead. So as an example, that's what we're doing. We're not going to be investing in the stock market from the end of this year, early next year and onwards. We're going to be gearing it all to cash, buying up the types of deals that we're buying for clients, so individual units, villas, townhouses, good to diversify across 2 markets like Sydney and Melbourne, in the markets that are set to go through the next growth cycle. And as you can't leverage from one deal to the next, my plan, this is what I'm doing, take it with a grain of salt. We're going to buy properties within Sydney and Melbourne, let them do the market cycle, the growth cycle, it's already commencing in Melbourne. Sydney's probably a year and a half away from starting. Once those markets do pump, like what happened from around 2007-8 to 2017, 2018, solid 10 years. Once we've held 2 or 3 properties in the super for 10 years, I am going to sell them down at peak market, pay off the debt, raise cash into the super fund to then reinvest it into the next market, like regional New South Wales, or potentially even go back up to Brisbane at that point, depending where each market's at, based off the 18-year land cycle, and move the money around. You can't refinance, you can't leverage. So in order to keep growing, you can buy property, let them go through their growth cycle, rather than holding it through a stagnant flat period that can last 10 plus years, sell them out, peak market, reinvest them into larger deals, blocks of apartments, do the same thing. Hold them through the next market cycle, fix them up, paint, flooring type of thing, maybe rip out kitchens, push rents, push yields, push values, hold them through the growth cycle, sell out, peak market to then keep rolling into future deals. So keep growing your super fund base. And ultimately the benefit of doing this is you can buy property that you can leverage. So instead of having your, in our case, 200,000 in the market, we'll be able to leverage that up to $1 million of asset value in 2025, which will then get, based off the growth cycles that are about to commence in likes of Sydney, Melbourne, easily 7 to 8% per annum per year. So you're getting 70 to 80,000 growth on that asset value. You're expanding your asset pool than just having 200 grand in the market, which will probably get cut in half to 100,000 over the next 3 or 4 years once the market turns. So things to think about, food for thought. If you want help doing much of the same, shoot us an email. We can get on a call, discuss where you're at, see if you align with our strategy, and if we could work together to help you set up your self-managed super fund. I can point you in the direction of all the people you need to know to get you to the position where you're going to build your long-term sustainable portfolio, both in your personal name, in a trust, and in your super. Hope that helps. Until next time, thanks for watching.